Hi, today I'd like to talk to you about the energy markets globally, but more specifically about the oil prices. As you may know, that in the last several years, oil prices have been persistently relatively really low. And even after some of the traditional shocks to the market, which technically or traditionally should make oil prices go much higher, it didn't have that effect. Let me try to refresh your memories. First, let's go back 10 years, 2007 summer, July. Oil prices are dancing around $147 per barrel. And not much change fast forward another 7 years, come to 2014 fall, oil prices are dancing around $110, $115 per barrel. But suddenly, within 6 months, oil prices dipped to levels as low as $50 per barrel. And fast forward another year, 2016, January, February, we've actually seen oil prices dip to $29 per barrel. And there are several global, undeniably big factors driving this change in the energy markets. Because if you look at the second half of the 20th century, that what makes oil so valuable and what makes it so precious is affected by, number one, the control of the supply. And OPEC, the oil producing and exporting countries, usually had a dominant force in controlling supply. And the second one is the craving, the hunger, the demand for oil came from both developed markets and the emerging developing markets. Now, coming to the 2014 fall, several things have changed. And I think the most important factor that changed was countries like United States between 2008 and 2014 increased their energy output, energy production output by almost 80%. So we're talking about some developed countries almost doubling their energy production. The second global important factor has been that OPEC lost its ability to be a monopoly over supply of oil, meaning that other parts of the world, other pockets of newfound resources, energy resources, have become also very important. So the markets, of course, with also the technological improvements, were able to better shift their demand to different suppliers in the world. So when OPEC tried to control the supply, traditionally, even the talk of an OPEC output cut, supply cut, would normally increase the oil prices. But in the last couple of years, we've seen that OPEC countries had meeting after meeting and announcement after announcement, but that didn't change much. Another undeniably big force has been our technological improvements, which means that we are becoming ever more efficient with doing more with less energy. And when you add to it two more factors that is controlling the supply, number one is the newfound resources in the traditional energy sources, whether it's oil or coal or depending on which country you're looking at and depending on their environmental protection laws. For example, China has been relentless in opening new coal power plants, coal-powered power plants, and that also put a dent in the demand for oil and other energy resources. But you can extend the examples like that. That's number one, the newfound resources in the traditional energy resources. But the second one, and really interesting one, is also our new alternative energy resources, whether it would be solar or more efficient use of nuclear or hydrogen fuel cell, or literally making the current technology more efficient in energy consumption, has made the energy markets completely different, and the dynamics have changed and shifted. Another global force that is making the new norm, the new dynamics in this market kind of puzzling for the traditional analyst is the regional trade. Regional trade, although it has enormous implications about productivity and prosperity in different pockets of the global economy, one other undeniably important factor has been that we became more efficient in transporting raw materials, finished products, flow of capital, labor in some instances, and regional trade made all of these things, not just the trading of the finished products between neighboring countries, but let's say that you would want a product and you are in Southeast Asia. Instead of buying it from Canada, the world economy has evolved into a new paradigm where it would be much cheaper for you to buy it from neighboring Vietnam, for example. And that alone had also a huge impact in how we understand the demand for energy. And as I said earlier, all of these factors combined with our ever increasing speed of efficiency increases made oil prices to be stabilized around $50. And $50 is actually a magic number, because if you look at the small producers in developed markets like the United States, as a result of whether it's fracking or shale gas or other alternative energy resources, $50, anything above $50 makes them profitable. So even when there is, let's say, a political crisis like Russia invading Ukraine or Crimea or a Middle East crisis, or political instability in Venezuela, or in the Middle East there is a talk about cutting oil supply, all of those traditionally would make the oil prices spike. But recently they didn't, because we are becoming more efficient in our energy demand, our production, and using less energy with it. Plus, in developed countries, the energy producers, small energy producers, suddenly become more profitable and come into the picture as long as the oil prices go above $50. That has been the main reason why, even with many political risks and instabilities, and even OPEC's push, we haven't seen oil prices go anywhere above, significantly, anywhere above mid-50s, and we don't expect it to happen unless there is a global shortage of supply. In fact, to the point that recently we have seen that storage of oil has become a problem and very costly for the oil producers and anybody in the chain of supplying oil to the energy markets. Hence, we don't expect to see energy prices, and mainly, or more specifically, oil prices, to spike up to traditional really high levels, as long as we don't see a big jolt or a global shortage or global cut in the oil supply.